After a turbulent 2020 marked mainly by COVID-19, what does 2021 look like from an investment and a trading perspective? Let's now catch up with Robert Alster, Chief Investment Officer at Close Brothers Asset Management. Robert, it's good to talk to you as we look into 2021. As I said, 2020 was really marked by COVID. There are obviously other things going on. How's 2021 looking like from this point?
Yeah, good question. 2021, we think, is going to be a sort of year of two halves, as it were, with the first half still being marked, as you suggest, by COVID. There'll be social distancing, the vaccine won't have been rolled out, so the hospitality sectors, unfortunately, are still going to be struggling. And then as we move into the second half, the vaccine gets rolled out, hospitality starts recovering, people feel more confident about spending, and the economy picks up. So you're going to get this very sort of bifurcated year. But the important thing, of course, is that in the first half, the government support mechanisms still carry on. And it's that money that is buoying asset prices, shares, bonds. And so you're going to get, we think, a very good market with government support in the first half and economic growth picking up in the second.
Okay, let's take a look first of all at equities. You mentioned there this aspect of the opportunity in 2021. What sort of sectors should we be looking at? You mentioned hospitality. Clearly, this has been one of those standout sectors to avoid in 2020. Airlines as well, I guess, another one which is really consumer facing. What about equities generally in 2021? What can you tell us, give us an insight into how you think the year will be marked?
Yeah, well, we think the sectors are going to be very much as they were in 2020, with, unfortunately, hospitality recovering or at least stabilising into the first half. But the winners are still going to be the online retailers, anything to do with the cloud, consumer electronics, and that growth carries on. That, we think, is structural, longer term, so carries through, which is why we're favouring the US tech. Now, in the second half of 2021, when hospitality emerges from the most dreadful period of trading it's ever seen, then you'll see those share prices move up and start discounting future comeback. And always in periods of crisis like this, the strong get stronger. So the important thing with these rebound hospitality stocks is to pick those that are going to be winners and actually capitalize on the destruction that's happened.
What about equities versus bonds?
Yeah, we're underweight bonds as quite a high conviction call, and on average sort of neutral equities, but within that overweight the US equities and technology sector and underweight the UK. The UK may be very cheap valuation, very attractively valued, but it's got lots of headwinds related to Brexit and the fact it's such an open economy and has been hit so hard by the pandemic. So broadly, neutral equities, underweight bonds, but overweight US equities. They're our core conviction beliefs.
What about other regions around the world, other geographies? How about the European Union, of course, ex-UK, because obviously from the 1st of January, we know that there will be a complete separation. We've been through this transition period. We don't know yet, as of the time of recording, what the outcome is going to be, whether or not we're going to get a deal. That could also obviously change anything depending on the outcome of those negotiations before the end of the year. But what about European Union? And of course, the biggest question is, what about Asia and China?
Yes, well, the European Union, to some extent, the manufacturing side, the auto, the engineering side, is very dependent on what happens in Asia. So the fact that the Asian countries, China, Southeast Asia, had a very good pandemic, for want of a better phrase, in terms of obviously being used to what happened with SARS and have recovered very quickly out of it, that is going to help the continental European countries. And of course, they will be getting the vaccine. They're also putting large amounts of government money into supporting the economy. So again, as we get through 2021, we expect quite a sharp rebound in European economies. In terms of European equities, there I think you have to be more selective. Europe doesn't have the technology sector that the US does, and whichever way you look at it, technology is going to win out longer term. So yes, there's selective European investments, certain engineering service companies, But if you're going to play technology, the US is the place to be. Asia and China, well, they are recovering as we speak. Very low rates of pandemic, so their recovery carries on. And again, it's down to selective investments. We are actually currently looking particularly closely at some Southeast Asia and emerging markets for playing those recovery plays. As yet, haven't settled quite on there. We have exposure to it, but yeah, I sympathise with anyone who's looking at those regions now.
What about global politics? Brexit aside, of course, that's going to change things on whatever happens there. But President Biden, what's a President Biden investment environment look like?
Yeah, it's interesting that, because President Biden will obviously be a more measured president in some ways than President Trump. So you'd expect geopolitical risk to ease off, and some of the trade agreements and frictions also to be scaled back. It's interesting because the US market was also worried that that President-elect Biden would be a very hard tax president, but because the houses are split, his power is actually curtailed. So rather bizarrely, you get a Goldilocks scenario of a president who's going to lower geopolitical tension and bring back trade. At the same time, he can't actually enact his more radical anti-marketing policies. And so you do get the benefit of both. So again, that's another argument for looking closely at the US. And of course, he's kept a lot of what he intends to do very close to him, and the size of the infrastructure program that's going to be put in place. The US is massively underinvested in its infrastructure, and Biden will change that. And the question becomes, what sort of deal and the size of it can he actually get through? And that'll boost all the companies, US, Europe, UK, that are actually geared in and have exposure to US infrastructure rebuild.
We've spoken briefly about the economic backdrop. What about interest rates? How are you positioning your investment strategy around the prospect for a change in some of the central bank's attitude to these very, very low, record low interest rates that we've been having? Do you see that particular market changing at all, interest rates?
Yeah, this is one of the most debated issues that we have on our floor at the moment. We really don't see inflation coming back, as some other market commentators do. We think it's going to be sub 2% for a lot longer, 1, 2, 3 years, and possibly beyond. So for us, the spectre of rising interest rates trying to put a cap on runaway inflation just is not there. And as a result of that, we think that bonds and fixed income in general have very rich valuations. And so we're staying away from that. And that's a call that we watch daily, the inflation numbers, and to what extent that's going to start picking up over the next couple of years. But at the moment, we just don't see that happening. For us, it's lower interest rates for longer.
What about these structural trends and how you see those changing? You've referenced us going online. Of course, that's been driven by the fact we're all at home, unable to do anything in the high street and anything else other than online, so shopping for whatever we need and so forth. What about the big trends going into the second half of next year? Do you see us reining back on that? Do you see a resurgent high street, for example, bricks and mortar retailing? Is that going to change? The structural way in which we've moved over this last year, do you see any change in what we've been doing, or do you think it's just more of the same?
No, I think there are changes. I think the high street is just going to rejuvenate. I'm not one of those who calls for the death of the high street. I've heard of the death of the high street at least 4 or 5 times in my career. What actually happens is large companies or large retailers do go and disappear. But the UK high street has a remarkable way of coming back and rejuvenating, and it may take several years to do that. But I'm a firm believer that that's what happens. In what form, it's always hard to tell. But I think successful retailers of the future won't just be online. They need to have multi-channels of distribution. People like shopping. People like going to see see clothes, try things on. So you'll have to have a multi-distribution, some bricks and mortar, some online. They're the retailers of the future. And all of that, of course, is backed up by the cloud. It's backed up by moving data. So there's all the companies, if you like, the plumbing almost of the internet. they're the companies we're looking to invest in as well, because they're the ones that have, multi-year, decade structural growth.
What about supply chains? We've spoken a lot in the last year about the way in which those have changed, and of course they've broken down a lot because of COVID-19. The fact we've not been able to get supplies across border and from our usual sources for whatever it is they might have been supplying. Do you see that we have changed forever in that regard? Do you think that we'll see shorter supply chains, more localized supply chains, or like retail? Do you think that's going to go back to how it was?
It's interesting, isn't it? Because what COVID introduced was the idea of sort of supply chain resilience. Do you have a supply chain which is resilient to these shocks like the pandemic? And I think companies all over the world are re-examining their supply chains, and they're bound to bring some back, make them closer and shorter, sort of reshoring. But I guess the real concern on this is, what does China do? Coming back to your question about the Far East, because China must be sitting there thinking, perhaps we need our own global positioning system, our own internet, our own mobile phone operating software. So there's a worry that to some extent the globalization that we've all seen and benefited from over the last 20 years is going to fragment slightly, with the Chinese going one way, the West the other. Clearly it's growing, but perhaps it won't be quite as seamless as in the past. And given what happened with the pandemic, who can blame either side for doing and thinking like that?
One other thing, of course, 2020 has been marked for is the rise of Tesla, and that really is the barometer of what's happening in electric vehicles. People pinning everything on that one electric vehicle manufacturer. But we've got to remember, of course, Tesla is, in terms of production, still a relatively small producer of vehicles. And we've got all the really big traditional vehicle manufacturers standing in the background waiting for the opportunity. Do you see electric vehicles continuing on the trajectory that we've had over 2020? And do you see an opportunity here for us perhaps maybe to look at other automakers to come into this new and burgeoning sector?
Yes, I think that's one definite trend. We seem to have turned the cusp of electric vehicles, for them being very rare, to actually getting traction behind them. All the climate change targets are being carbon neutral, reducing CO2 emissions over the next 10 years, and the UK's stance being particularly aggressive on that suggests that electric vehicle demand is here to stay. And the car companies are reacting. Even the sort of more traditional ones are pouring tens of billions of sterling and euros into upping their electric car range. And of course, it's all about the infrastructure, the charging points, and also about battery storage. And all of that is moving very, very quickly. So, range anxiety is disappearing as batteries become more efficient. Infrastructure will be rolled out. So, yeah, I think the electric car very much is the car of the future. In terms of Tesla, and it's an absolutely remarkable share price rise, I think it's being valued as a technology company, not as a car company, because, of course, it has intellectual property in how its battery works and a lot of the software. So that's becoming a tech company.
And of course, one of the things that goes hand in hand with electric vehicles, but in fact is going to affect us more and more, I know, is artificial intelligence. How do you see that affecting us over the next, well, not just 1 year? I mean, we're talking here about the next decades. I know this is just a small sector at the moment, but how do you see things changing possibly next year and into the years ahead?
Yeah, now artificial intelligence is one of the hardest things. You sort of can't model it. It's about the future in such a different way than we're used to. It's almost like laying down option money. You don't quite know which area of life it's going to excel at next or replace. You just know that over time, with increased computing power, it is going to actually dominate and be part of more of our lives. So the way to play that is to play those companies that also understand and lay down those options, if you like. So, the alphabets of this world are particularly strong in this area, but we're looking for all those companies that hire artificial intelligence engineers. But it's going to affect just about every sector, whether it be healthcare, to playing chess, Go, autonomous vehicles, my own financial analysis, every area of life. It's a question of trying to pick the winners.
Okay, Robert, look, it's great to be able to catch up with you again. And I hope that you and your family stay safe over the Christmas and New Year period. And we look forward to speaking to you again in 2021 when we experience some of those expectations that we're looking at this stage in December. And of course, I said the interview was undertaken before we know the outcome of the Brexit negotiations. So, of course, keep that in mind when listening to the commentary that we've just been hearing from Robert Alster. He's the Chief Investment Officer at Toast Brothers Asset Management. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.